Hello and welcome to our new investment strategy update. Recession risks just got bigger. Global activity is slowing in response to the most aggressive interest rate hikes in decades. As demand slows and supply disruptions improve, price rises for goods are slowing, but the cost of services is now increasing, keeping inflation uncomfortably high. In the US, strong wage growth and a tight labor market will need to adjust before the Fed can ease off the pace. If its monetary tightening proves enough to curb inflation in the coming months, we expect rates to peak at around 4.5% and stay there for most of 2023. The Fed's inflation fight indeed comes at a cost. We expect a recession and for US growth to fall to around 0.5% next year as unemployment rises to at least 5%. If rate rises to 5% or beyond, then the contraction could prove even more painful. The energy crisis remains an issue across the world, but especially in Europe. Russian aggression in Ukraine is escalating, but we still expect the conflict to remain contained within eastern Ukraine. Meanwhile, European authorities have been hard at work sourcing alternative energy supplies and providing significant policy support. This should help avoid a full-scale crisis this winter. But recession looks inevitable, especially as the continent also faces further sharp rate rises. In China, the fiscal and monetary response is strengthening as growth slows. The property sector and the zero-COVID strategy remain major headwinds, but we expect some easing on the latter after the Communist Party's 20th National Congress. China is the last pandemic reopening story with scope for a major growth rebound next year. To sum up, the world faces unparalleled economic challenges at a time of shifting geopolitical balance, and central banks have little margin for error. Let's now find out from Stéphane how we are investing client portfolios in this environment.
As Samy just outlined, the last quarter of 2022 will be challenging for investors. High inflation, rising rates, slowing growth, and geopolitical tensions all have major market impacts. The risk of recession are not yet fully priced. Interest rate will continue to drive asset returns, and as central banks tighten monetary conditions further, a deeper economic contraction is more likely. That's why we have reduced risk in our clients' portfolios to a more defensive level. In equities, we have taken profit on UK positions and increased more defensive Swiss stocks. We maintain our overweight in Chinese equities. While China faces challenges that Samy mentioned earlier, its stock market has a low correlation with global equities, valuations are attractive, and monetary and fiscal support should boost growth. To continue to shield stock exposure from higher inflation and downside market risk, we have extended our hedging strategies on US and European indices to end December. In fixed income, we have diversified exposures further by reducing holdings of convertible bonds and increasing our position in Treasury inflation-protected securities, as well as in Chinese sovereign debt hedged into US dollars. We retain our view of a stronger US dollar and Swiss franc and expect more weakness for the euro and sterling. Finally, we have lowered our exposures to European real estate and broad commodities. Instead, we have increased macro and trend-following hedge fund strategies whose performance is usually uncorrelated with markets. More volatility is inevitable. Central banks' fight against inflation will test markets, shifting risks and opportunities as new geopolitical and economic equilibriums emerge. We keep a strong focus on quality assets to strengthen your portfolio's resilience. Thank you very much for watching.